Hey guys, hope everybody's doing well this Wednesday. It's actually Monday night for me. I'm recording this for Wednesday, but hope you guys are having a great week. In this video today, Wednesdays I usually cover something with options. I'm just going to share with you a couple of positions that I'm in. Nothing big has happened, but I closed a position, started a position, and got assigned a position. And I also want to talk about what it means to roll a contract. And to be honest with you, me personally, I hate the term roll. It makes zero sense to me, and I think it confuses a lot of people as well. So I'm going to try to say it in plain English, what rolling a contract actually means, okay? And that's going to be toward the end of the video after we get through these positions. So if you're new here, please like, share, subscribe, do all that good stuff that I, always say. I'd appreciate it. So it's down in the pinned comment, by the way. And so we'll get through it. What you'll see on the screen right now is my Palantir buy right, which has turned into a wheel. Well, if you remember, last week I sold on April 12th, I sold a put that expired on 4/16, which was Friday. It had a strike price of $23.50. I collected 50 cents on that thing, and it expired in the monies by about $1. It went down to like $22.50, but I had to buy it. I bought it at $23.50, and then this Monday it actually stayed down, so I did not open up a covered call position on it. I'm just holding the shares right now at $23.50 cost basis. But when you minus all the profits that I've taken from calls and puts, my cost basis is still down $22.27, which is still over what it's trading for now. So what's the plan? The plan is to wait for an up day. When you sell puts, it's always best to sell on a down day. Usually premiums are higher. And when you sell calls or covered calls, it's usually best to wait on an up day, because those are when premiums are higher on calls. So right now I have nothing, no calls on it. I'm just holding the 100 shares. And currently I'm just under 1% in gains on this position. So that's Palantir. Hopefully Tuesday, or actually yesterday, hopefully I will have written a call option on this. We'll see. We'll just have to play it by ear. Next up, I entered a position. I forgot to share this one last week, but it is on Tilray. Now, what you'll see empty fields there because I don't own any of the stock. Okay. On April 12th, I sold a $16 put strike contract with a 4/16 expiration, collected 30 cents. And then on Thursday, I think that contract was only worth 3 cents. So I bought it back and put on, 4/15 was a Thursday. I bought it back for 3 cents, and I put on the following week's $16 strike and collected 40 cents. So that's about a 7-cent improvement, right? So right now, it's at 17.44. Doesn't look like I'll get assigned, but we'll see. You never know. These MJ stocks are kind of volatile. But right now, over the past 2 weeks, we've collected $65.62 and don't own the stock. And I'll keep selling these puts and until I get assigned. If I don't get assigned, then we'll just keep track of how much money you can make not owning stock, right? So that's Tilray. Now, the big one that I did last week was I closed out my final PMCC, and that was on Pfizer. And you'll see right here, Pfizer, I closed out on April 7th. I closed out my final covered calls on it, and then I let the leaps ride. I let the stock run up, right? And it did run up. It ran up a lot, actually. After I got out of the position, of course, but I'm happy with what we did on April 13th. We closed out a Pfizer, all 3 leaps at a price of $12.50 each. So this position On covered calls, I collected from January 26th until April 13th, $195.52, and I profited off of these leaps $315 for a grand total profit of $510.52, or a total return of 14.86%. And that's January 26th to 4/13. That's not quite 3 months, 2.5 months. I'll take that, every day plus Sunday. Because if you look, right, you look at Pfizer, if we look at the ETF channel, just type in Pfizer. And we look from January 26th, when I entered the position, right? I bought my first leap on January 26th. And then I closed it out April 13th, 2021. We'll see how much someone who just bought the stock would have made. And they would have made 0.68% by just buying the stock and sitting on it for 2.5 months. You would have made 0.68%. There might have been a dividend in there that you might have got, but pretty much you got 0.68% on your money from January 26th to April 13th. So I'm super excited that Pfizer, I was able to squeeze out 14.86% out of that stock. And that is kind of the power of options, right? You make money regardless, kind of regardless of what the stock's doing, if that makes sense. You don't even have to own it. In this case, I did own leaps, but in a lot of cases, you don't even have to own stock to make money in the stock market, just like Tilray. I don't own Tilray, but I've made $65.62 in a matter of a couple of weeks on it. It's fine with me. So those are the position updates. And the one I wanted to talk about is rolling. What does it mean to roll a contract? Because you always hear people say, well, if I get into trouble, I'll just roll it. And it's really false, because you're not rolling the contract, right? Okay, let's take a look. I'll try to explain what I mean in plain English. Let's say you sold on April 12th, you sold a put with a 4/16 expiration. At the time you sold the put, it was $24. You had a $23 strike on it, right? And let's say you collected $1. I'm just using round numbers here. Let's say you collected $1. Okay, that's $100 in profit, essentially. Let's say the stock just dropped all the way out and it's, under $22 or under your strike, right? Now that contract, you're going to either have to buy the stock at $23, or you can, quote unquote, roll the position. What does rolling mean? Well, let's just say that this contract, because it went deep into the money, is now worth $2. Okay, follow me now. To buy that contract back and roll it, you have to pay $2 now to buy that back. So now, instead of a total profit of $100, you have you're negative 100. You're negative 100 because you had to buy the $100. You had to buy back the premium you received plus the other 100, right? So you're actually $200 in the hole. Okay, because you had to you're $100 in the hole, but the contract is now worth $2. So if the contract is now worth $2 and you paid $2 to get that back, that contract is done. Okay, the contract is done. You're not rolling a contract. The contract is over with. You bought the contract back at $2, closed the position. That contract is gone. Nobody owns that contract no more. You bought it back, it's done. Now, when you're down $200, now what you can do now is look for a strike at a later date that covers what you had to pay to close this position out, right? So if you paid $200 to close the position out, you need to find a contract or multiple contracts that will cover that $200 that you had to pay to get out of that contract. I hope that makes sense. I'm trying to explain it. I'm trying to confuse myself. But if you buy something back at a loss, you took a loss on that contract. There is no rolling that contract. I don't know where this term came from, but it's kind of dumb because that contract that you bought back does not exist anymore. You have to enter a new contract to cover the loss that you had to take on the original contract. Now, we get caught up sometimes that we absolutely have to look at that same position, that same stock, and try to make that $200 loss back. And you really don't have to, okay? You can make up that $200 somewhere else. You don't have to stay stuck in a dead stock if that stock turned for the worst, premium's not there, bad news came out, they had horrible earnings, and here you are trying to salvage the loss of that contract from a dead stock possibly, right? So you really have to weigh those scenarios, stock by stock, right? You might be best off taking the loss, walking away, and not even worrying about rolling that contract or getting that money back from that same stock. You can get it from another stock. If you can make $200 from another stock, that wipes out this one, right? So this thought of rolling a contract really bugs me because it confuses most people, especially new people. It confuses the heck out of them. And it makes it sound like that contract that you originally sold is somehow still involved in the transaction. And that contract you originally sold that you bought back is no longer in the transaction whatsoever. I hope that makes some sort of sense. I'm trying to explain it as in plain English as possible. And a lot of times explaining options is almost impossible in plain English. I think that's why they come up with these. Oh, just roll the contract out to next week at a lower strike, right? So it's one of them that is one of my pet peeves that I hate. I still use the term because it's universally accepted as the right way to talk about it, but essentially rolling is buying back the contract you originally sold at a loss and looking for another opportunity to make up that loss in another contract, either in the same stock or another stock. That's it in a nutshell. I hope that helped. If you guys have any questions, please leave them down below. Like, share, subscribe, do all that good stuff. You guys have a great week, and we'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.